Well, thank you both for coming, appreciate it. I'm David Tourtillot. This is my second time here. I was here, I don't know, about 6 months ago with a couple of ladies, realtors, and we were talking about various subjects. But today it's just on reverse mortgages. I live in Situate, a South Shore guy. I've been originating reverse mortgages for 17 years. It's all I do for a living. And so what I'm going to do today at a high level is just walk you through what one is, the pros and the cons. And I don't expect you to understand what it completely is. I'm just trying to give you a general overview of what it is. But what I'm going to do first, I love this little, it's about a 2-minute clip. And it's a visual of how reverse mortgage works. So I'm just going to start this video, okay? So we'll watch this first and then I'll go through my presentation.
What is a reverse mortgage? A reverse mortgage lets you convert part of your home's equity into cash without selling the house or making monthly mortgage payments. And you can live in the home for as long as you meet the loan obligations. Instead of putting money into a house by making monthly payments on a traditional mortgage, you can take money out of your home's equity. That's why it's called a reverse mortgage. Similar to a HELOC or cash-out refinance, you can choose a lump sum disbursement, monthly payments, or establish a line of credit or combination of these. For those with higher home values, special products exist to maximize your benefits, up to $4 million. To qualify, you typically need to be 62 years old or older, own the home, live in it as your primary residence, and undergo a financial evaluation. You also need to pay property taxes and homeowners insurance and maintain the property, just like with a traditional mortgage. Reverse mortgages have evolved over the past decade, so it's important to know the bank does not own your home. You maintain ownership, and if the loan obligations are met, the bank can't take possession of the house. Your heirs never inherit the debt. They may keep the house and pay off the loan, or sell the home and take the profits. But they're not personally responsible for debt if the house depreciates in value. Reverse mortgages can often improve cash flow at all income levels, including for affluent individuals. With a reverse mortgage, you are in charge. In most cases, you're free to spend the money however you choose to cover medical and long-term care expenses, pay off an existing mortgage, fund grandchildren's education, or travel.
I like that because it's a visual, right? It just gives you sort of a sense as to what a reverse mortgage is. And the best way to understand a reverse mortgage, you're familiar with what a mortgage is, right?
Oh, yes.
We've all had them. You take them out the same way. You take it out through a local bank, a lender. That's typically how you get a mortgage on a home. And the same holds true here. You have to take it out through a lender or a bank. And the way you take it out is you sign paperwork, you figure out the terms of the loan, how much you qualify for, and then the mortgage itself is called a reverse mortgage because of the fact that a regular mortgage I call a forward mortgage. You take the loan out through a lender, and like me, I pay Chase back $2,300 every month for 30 years. I pay it forward, meaning I'm depositing money into my home to create equity. With a reverse mortgage, you've paid off your house in most cases at this age. Some people still have small mortgages. But this mortgage was put in place by our federal government 34 years ago as a way for you to tap into the wealth in your home. But the only way to do it is you set a mortgage up against it. But the mortgage is a tool or a mechanism that allows you to reach into that mortgage and take money out of the house. And you don't have a monthly mortgage payment obligation with these. All other mortgages nationwide require a payment on the first of every month, without exception. If I skip payments, Chase can take my home. On a reverse mortgage, you're setting up roughly about 40 to 50% of the home's appraised value. And that is now wealth that you can tap into. And it's almost like you're selling half your house and getting the cash, but you get to stay in the house. Okay? You don't have to sell your house. You don't have to move out of the house. So it's important to know that. And the other thing is, who's in charge of this loan? So HUD, you know who HUD is, right? Housing and Urban Development. They're a federal housing agency. And FHA, which is Federal Housing Administration, they designed this loan 34 years ago during the Reagan administration. The reason they designed it is they knew the baby boomers were coming of age. and they knew it was gonna be a large population getting into those retirement years, and they knew that we were living longer, so they said, hey, we have to kind of think about this in advance, because what if someone retires at 65 and they live to 95? Well, we all know what inflation can do to your retirement income, right? And your savings. So it was a way to not have to be faced with selling your house. It was a way to say, okay, all else has failed, but I have wealth. So I can set up a reverse mortgage and tap into that asset that I have and take cash out and stay here the rest of my life. That was sort of the mission statement when FHA and HUD designed this, was to allow you to age in place and not have to sell the home because of financial issues. But it's really a tool, in my opinion, because it goes across needs-based borrowers, affluent borrowers. There's many different ways to use it. It's a tool. So let's get right into this. So we'll talk about some of the trends that are causing reverse mortgages to go mainstream. Again, it's been around for 34 years. It was enacted into law in 1988. So a lot of people think these things are scams. But do you think we're going to enact a scam through Congress? Well, that doesn't mean that there wasn't problems with it.
Yeah, but a lot of brokers have taken advantage of people who
That's
are
right.
not too smart, and they've gotten commissions which are outside the box.
That's right.
Everybody knows that.
All I'm saying is it was never the loan that was the problem. It wasn't this instrument is a bad thing. It was the way it was sold, who it was sold to, and how it was structured. Just like you said, you had bad actors. And so all of those problems have been fixed for the most part, 34 years down the road, for many reasons. So we'll go over what a reverse mortgage is, the concerns that I see at my clients when I sit down with families, the benefits, how to qualify, what the costs are, some of the common misconceptions, and how to get a reverse mortgage. So some of the most obvious trends are is we have 10,000 people turning age 65 every day for the next 10 to 15 years, every single day. And we're living longer because we have pills that keep us around longer. The desire to age in place, not go to a nursing home. Like the old days, it was just thought of, well, doesn't seem like you can be cared for here anymore, Mom, so let's sell the house and put you into a rehab facility. Now you can take a reverse mortgage out, use that money to have an in-home care company come to the house instead of going to a nursing home and pay for it that way. And folks are looking at alternative ways to supplement their income. So you have savings, right? You save money up during your working years, you accumulated savings. And so this is just another thing that you accumulated wealth in, was your house by making payments the first of every month for many, many years. And by the time you're 65, that could be in the hundreds of thousands of dollars that you've dumped into your house in the form of payments. So this just allows you to go at this asset and take money out to supplement your income. When I go to sit down with families, I usually say something like, why are we together today? And all I'm getting at is everybody has a different reason for why they're looking into a reverse mortgage. And I like to hear that reason because it gives me something to work on, work off of, to determine if this is even the right fit for them. Because it's not the right option for everybody. There's other alternatives to a reverse mortgage. So, but usually they'll mention things like this, well, my health care costs are going up, I'm on fixed income, and that's outpacing my income, and I'm starting to feel the pinch, or the cost of living. You know all the things. The list goes on and on. I don't have to read those. Excuse me. And so what is a reverse mortgage? It's a loan designed specifically for people 62 and older. You have to be 62 or older to qualify. And it allows you access to roughly 40 to 55%. The younger you are, that's what you get for a younger person around age 62. As you get up into the 80s, you get about 55% of your home's value. So it's a sliding scale. So we don't lend money based on your monthly income. We lend money based on the youngest borrower's age and the appraised value. That's because there's no payment. So on all other mortgages, they look at your income to see how much they can lend you because you're going to make a payment back.
Right.
So it's federally insured. HUD and FHA are in charge of this loan nationwide. We are just facilitators of this loan that happens to be enacted and regulated by HUD federally. And so they give us this loan and we can offer it, but we offer it based on their rules. It's not our loan, it's not our product. And that's a net, so it's basically a level playing field nationwide, all 50 states. The closing costs are standardized by HUD. The amount you can borrow is determined by HUD. It's a factor
And
of
HUD
the,
provides the cash.
no, HUD's not the bank.
Funds, who funds it?
A lender. So there's lenders and banks nationwide that we use. HUD's not a lender. HUD's a federal housing agency that invented this loan, and then they gave it to the lenders nationwide. It could be Bank of America.
Oh, okay.
They offer it for their customers, but they offer it based on HUD's rules.
Right.
So no one can make up their own rules on this product. It's HUD's rules. So it's good to know that, because you might say, well, should I talk to 10 different banks? And you could, but everything's going to be very similar because it's a HUD loan. They determine the loan amount, they standardize the cost. So there's not a lot of difference between one person and the
So you're
next.
competing against the major banks around the town?
Not around the town, because usually local banks don't offer it.
Don't offer
It's the national lending warehouses that offer it. I'll throw a couple out, you might not know who they are. Reverse Mortgage Funding LLC out of New York,
it. Right.
Finance America Reverse out of California.
Right.
Big lending warehouses that HUD approved to offer it. So they originate and they underwrite the loan. But think of me like an insurance agent,
Yeah.
but I'm not your insurance carrier. We find a carrier, but I'm the agent, I'm the point of contact. So we partner with these large lenders. And so these loans are never paid back until the borrowers no longer live in the property. So if a married couple takes out a reverse mortgage, one passes away, nothing happens to the loan until the next person passes away. Or sells the home. Because when you take a reverse out, you can sell it. You're not locked into the home because you took a reverse mortgage out. If you take it out, life goes sideways and you want to sell it, you can. You just list it for sale with a realtor, pay off the mortgage as part of the sale, keep the difference, and move on to your next place. You can use a reverse mortgage to stay in your house and use a refinance as a reverse mortgage to tap into some of the equity in the house you're living in. Or you could sell that house because maybe you want to downsize to a smaller place, and you can take a reverse mortgage out on that next house as part of purchasing it as a reverse mortgage. So it can be used to refinance an existing home you live in, or to purchase another home you're going to buy. There's never monthly mortgage payments to be made on a reverse mortgage. You take the money, you borrow it, and that money will get repaid in the future when you don't live there with accrued interest. Okay? So there's no payment during your lifetime. It's a cash flow thing.
Right.
You get some of the money out of your house. They don't say, hey, pay us back every month. Just use the money. We'll get that money back down the road with interest. The interest you didn't pay us, basically. Because you know with a regular mortgage, you pay principal and interest as part of the payment, and sometimes taxes and insurance. So this one, you tap into roughly half of your home's value as cash. You're borrowing it. It's a mortgage. You can't say it's not a mortgage. It's cash. It's converting from equity into cash into your checking account. And now you can spend that money however you want, but you're not going to get a statement every month that says, this is your payment to send
But
back.
interest accrues from the time you do that.
Exactly. Only on what you borrow.
So just for the hell of it, what is the rate currently versus where it's been, say, since Biden became the president?
Well, about a year and a half ago, it was about 2.7%. Now, these are variable rates. They do have fixed rate reverse mortgages, but 95% of the ones done nationwide are variable because they act a lot like home equity lines of credit.
Right.
Open-ended, meaning it's a line of credit against you.
The rate flows.
The rate flows. So last year around this time, the rates were probably about 2.7%, the adjustable rate. They're about 7.3% today.
Yeah.
Yeah. So you would be deferring interest at the higher rate, only on what you borrow though. So I have a lot of folks that don't have mortgages on their house now.
Right.
They're setting up the loan as a line of credit.
Right.
There's no balance though. You haven't borrowed it.
Right.
So when you borrow it, that's what accrues the interest on that annual rate. Good question. And so the formal name of this loan that HUD gave it, you'll see online the acronym HECM, Home Equity Conversion Mortgage. It is what it says. But they put reverse mortgage there because it works opposite of a regular mortgage. So a regular mortgage, you make a payment every month, and what does the balance do? Goes down, right? Reverse mortgage, you borrow the money, you make no payment, what does the balance do? Goes up. It just goes opposite. And on a regular mortgage, you pay the bank back every month forward, the payment. This one, you ask for the money from the bank out of your mortgage. So they pay you a lump sum, a payment, combination of the both, set it up as a line of credit, and draw it as you need it. And so it's 100% backed and insured by FHA and HUD. What does that mean? When you take a reverse mortgage out, we're going to get into this. One of the closing costs is an upfront insurance fee. That's equal to 2% of your home's appraised value. You get a $600,000 house, that's $12,000, not out of pocket. It's coming out of the loan. It's rolling into the loan. It's coming out of the equity of the home. Goes to FHA one time. Everybody nationwide pays 2% of their home's value out of their loan proceeds. It rolls in. And that sits at a fund at FHA. And if people live a long time after they take this loan out, and they borrow the money quick, and the interest is accruing, and at the time they pass away, the housing market crashes, and the kids inherit the house. You see where I'm going? I'm trying to exaggerate a situation. And the kids find that the loan balance is more than what the house is worth, because they lived 20 or 30 years after they took the reverse mortgage out. No one's on the hook for that, because of that insurance fee that was paid. The kids just don't get anything when the house sells, but they're not hassled. They're not left with a deficiency judgment. They're not chased by the bank for the difference. FHA sends that money back to the lender behind the scenes after the house sells. The lender says, hey, the reverse mortgage balance was $500,000. We only sold it for $450. We want the other $50 back. And they say, oh, well, that person paid $12,000 when they took their reverse mortgage out in insurance money.
So that 12,000, the fee you're talking about, is strictly for in the event.
In the event.
In the event something goes wrong as you just described.
Yep. Just like auto insurance or homeowners. We have insurance in the event something happens and we're covered. So that covers that. Now, if someone passes away and there is equity in the house, the insurance didn't have to be put into play.
Right.
The kids sell it for $6, the reverse mortgage balance was $300, the kids walk away with $300.
Does
So that
the
just
2%
protects it.
fee ever change?
It has changed in my 17 years. It goes up and down. It depends on what's going on. They pay an awful lot of claims, believe it or not, out of that fund. Meaning, homes do come back upside down. So they pay out more claims than they're receiving money, so they will adjust that periodically. It's been at 2% now for about 5 years.
So what in your business, what do you see as upside down percentage-wise? versus-
I haven't had one yet,
You haven't had.
but I've only been in the business 17 years. I say only.
Sorry, I called it.
If I was in the business for 30 years, I might have had someone in the 90s that did a reverse mortgage and they lived to 95.
Right.
It could happen.
Right.
But when we sit down with a family, we let them know that insurance protects them from that. And the worst case scenario is the kids may or may not get money. It depends on how long their parents live. But the kids generally say something like, we don't care. It's not our house. We have our own house. If there's money left, great. If there's no money left, fine. Mom and dad were happy. They used the money in their house. They were able to stay here, live comfortably. We're not banking on money from mom or dad's house. That's typically what most kids say. And then the backing part, it's insured. And the backing part is, lenders can go out of business, right? We saw 300 banks go out of business in 2008. I saw that happen, the housing market crisis.
Yeah.
If you take a reverse mortgage out today with reverse mortgage funding, 10 years goes by and they go out of business. HUD's already on record at the Registry of Deeds as the beneficiary of that mortgage. Meaning nothing would happen to you, but you would just have a new servicer mailing you statements with the terms remaining the same so that you can still get your money. So it's a guarantee. To qualify, you have to be 62 or older. to qualify. So that's the minimum age. There's no maximum age. I have clients in their late 90s to take them out. They're taking it out for
at 90?
well, they're taking it out and working through the kids as powers of attorney. Probably the parents are mentally incapacitated, having in-home care in the house,
Right.
and the kids are looking to help pay for that.
Right.
So they set the reverse mortgage up against their mom or dad's house to grant them their wishes of staying in the house, but they're running out of money, so they had to go get more money out of the reverse.
Right.
And so 62 or older has to be a primary residence home. You can't take a reverse out on a second home or an investment property. And it can be a 1 to 4 unit home. In other words, if you owned a 3-family and you lived on the bottom floor, you could take a reverse out on the whole property, as long as you live in that. And then condos are the same. You can take one out. It's just the complex has to be reviewed by HUD to make sure they have sufficient money in their reserve account. There's no lawsuits or litigation going on within the complex. Oh, let me go back. So the amount you qualify for is based on the age of the youngest borrower, the date of birth, the appraised value, and what rates are doing at that time. And that slide, you remember the 40 to 55%? Those three things based on the age will say someone maybe who's 67 might qualify for 46%. 83 would be 70%. I'm sorry, 57%.
Right.
Benefits. You can tap into your house's value without having to sell it, about half, not the whole house. And use it like cash to help you out as paid back in the future, so you don't have to make payments. Now, if you were the one that won $970 million the other day, and you wanted to pay your balance down, because you had a reverse mortgage, you can. There's no penalty to pay it down.
Right.
You just never want to close out a reverse mortgage and pay it down to zero.
So what is the fee to pay it down? There must be some
There's
charge.
there's no fee,
Nothing at all?
nothing.
Zero?
'Cause you're
No
paying-
sink attack, no nothing?
You're paying a fee with interest, so part of that fee you're paying back is interest. It's all interest, actually, and the amount you borrow. So, but there's no, oh, you're paying us back early, we're going to charge you $1,000 for that. There's no prepayment penalty fee. HUD won't allow that. So again, no prepayment penalty, so you get into the loan, you want to sell it in 5 years, you can. I don't advise that, though. When I speak to people, if they say, we'd like to stay here long-term, then we know we're looking down the right path. It's a tool to work, it's worth getting educated on. If they tell me we're thinking of moving to Florida in 5 years or South Carolina, I would still educate them on it, but I wouldn't advise them to do it because of the costs associated with it for a short period of time. Doesn't make sense mathematically, right? Because we all know when you sell a house, it costs 5%.
Right.
It costs more to sell a house than it does to stay and do a reverse mortgage. And then once the last person leaves the home permanently, they die, they sell it, or they go into a nursing home, that's when the loan becomes due. Okay? Most people, I have over 500 reverse mortgage clients in Massachusetts and Florida. Most of them, this is kind of the common theme. You know, they'll say, hey Dave, you know, I just have more peace of mind. I feel better that I have this large asset of cash to tap into if something goes sideways. I'm glad I have it, and I feel better. So that's typically, it's peace of mind that is the driving force because, you know, inflation can create a lot of stress. Common uses, increase monthly cash flow. So you're making $2,000 a month Social Security, $800 a month pension, and you're paying your bills and you have about $600 left. You're sick and tired of that, right? But you got a lot of equity in the house. And this allows you to say, well, I'm going to tap into that and I'm going to take another $2,000 a month from my reverse mortgage so I have some peace of mind. I have some breathing room. You know, I'm not living to the penny.
Right.
A lot of people have mortgages in retirement. So what we do for them is we take a reverse mortgage out, refinance their regular mortgages into the reverse, and guess what happens there? You've just taken mortgages that have payments, put them into a mortgage that doesn't have payments, so now they save the money that they were making the payments on. So if someone had a $200,000 mortgage with a $2,000 a month payment, we push that into a reverse mortgage, we've just saved them $2,000 a month because they don't have a payment anymore. They have a mortgage, but no payment.
But it's accruing interest
It's accruing interest.
regardless.
Right.
You dump that in, the thing is going up, you're gonna pay more.
The whole idea, when you think of, yes, it's eroding equity, it's doing all of that, but it's allowing you to stay there. And the kids, if the kids say, it's okay, we don't care what the balance is. If you show me next Thanksgiving that you accrued 50 grand in interest and it's still worth 300,000 more than your loan balance, it's okay. You get to stay here and have additional cash. Not saying it's for everybody, but the mindset when you go into reverse is not worrying about the interest. Otherwise, you shouldn't do it. The whole mindset is you're trying to fix a financial problem. And whether you spend money from an IRA, or you spend money from your house, it makes no difference really, whether you spend it from your house or your IRA and you die, you're leaving behind the net difference to the estate, whether you spent it from your house or the
And you're
IRA.
having to pay an MDR every year, if you're pulling out of an IRA or 401K.
That's right. When you take this money, it's income tax-free too. It's an income tax-free resource because you're borrowing the money. So you don't add any money you take from a reverse mortgage to your tax returns as income because you're borrowing it. It feels like income, right, because you're getting this money out of your house, but you didn't earn that, you borrowed that. So pay off existing mortgages will enhance cash flow because you won't have the payments anymore. Take it out to modify the home to age in place, maybe widen the hallways, put a ramp in. Use the money to do that so you can stay in that house, but make sure it's gonna fit your needs, suit your needs. And then another thing for the affluent is you can set up a reverse mortgage on your house, all as a line of credit. So if you have $1 million in savings, and you got this house free and clear, and let's say it's worth $800,000, you could set up a $400,000 line of credit, and that can be coordinated with your portfolio. It's in your house, in your portfolio, but the portfolio, what can happen to a portfolio? You go up and down, right?
Right.
In stock markets. This line of credit limit can only go up. So there's a growth rate that's attached to these lines of credit, which to me is the secret sauce and why I'm in the business. It confuses the you-know-what out of people when I talk about this, but if you set up a $400,000 line of credit with a reverse mortgage, that credit limit rises the same interest rate. So it's just more money to borrow. But affluent people like that because they've got this hedge against some of their home's equity that's growing always. Nothing can make it not grow. If the home value goes down, the line of credit still goes up. But if the stock portfolio goes down and you draw money from it, you don't want to continue drawing money from your portfolio when it's going down. So affluent people stop drawing from their portfolio and they go and take the money from the line of credit as a backup buffer asset when the market's down. And then they go back to the portfolio when it recovers. So it's a back and forth type of thing.
Right.
Some people take a reverse mortgage out on their primary residence and they use that to buy a second home, like a condo. They buy that cash. So now they took the reverse out on the house they live in, that's their primary home. No mortgage payment. They took the cash out though. They bought a condo cash with it and they have that now without a mortgage payment. So you have two homes without a mortgage payment, but you have a large mortgage balance accruing interest on the primary home. But it's just a way to strategize. And this stands for reverse equity line of credit. We all know what a home equity line of credit is. Reverse equity line of credit is much safer if you're retired. It can never be frozen or suspended when home values go down. Home equity lines of credit can be suspended. That's why they only cost $200 to put in place. You can use it when times are good. When times aren't good, the bank has the ability to say, I'm sorry, Tom, you can't use that right now. You can't do that on the reverse equity line of credit because you paid a hefty fee to get the guarantee of being able to access that $12,000 fee we talked about. So you're paying a premium to always have access to the line of credit. Now, this is very important. What's the responsibilities of a reverse mortgage borrower? You have to pay your property taxes on time, keep the home insured, live there, and maintain the home. All those things you're doing right now, with or without a mortgage. But that's what keeps the line of credit and everything in place without a problem. If you skip a few payments with the town of Foxborough, it could create a problem. But it'll create a problem with the town of Foxborough too, not just the lender. So that's the basic responsibilities. Live there, pay the taxes on time, keep the house insured, and maintain the home. We already talked about this, I'm going to skip over that. They've made a lot of changes to this loan. Since around 2015, I wrote my first reverse mortgage in 2005. They've made a HUD, when I say they, HUD makes tweaks to the program to make it safer. More safeguards for the consumer. But since around 2015, this loan is very transparent, very shored up now financially. And so if you don't get through the pre-qual process, by default, a reverse mortgage was not the right fit for you. Prior to 2015.
And that's largely on your credit rating at the time you apply.
Yeah,
That's the only thing that will kill it.
Right,
It's not enough,
right,
point-wise.
that's right. So we never looked at credit reports,
Never did?
income, prior to 2015. We did, but we never factored that into what someone could borrow. But it created a problem. From 1988 up until around 2015, if you were 62 and older, and you could breathe and fog a mirror, you could get a reverse mortgage. But guess what? If someone has bad financial habits and bad credit, and you set them up with a reverse mortgage, is that going to serve them long term? Or do you think the habits are going to continue on with that money?
No.
So they were being irresponsible with the reverse mortgage, spending through that quickly. Now they were falling behind on their property taxes and homeowners insurance while they had the reverse mortgage.
Because they weren't vetted.
They weren't vetted. And that was HUD's unintended consequence. HUD in their mind said in 1988, if someone doesn't have a mortgage payment, why do we really care about income and credit? They don't have a payment. But my cost of living far outweighs my mortgage payment. So just being mortgage payment free is not putting anyone on easy street.
Right.
So it was an unintended consequence. So around 2015, the lenders are putting a lot of pressure on HUD and saying, listen, because the lenders were paying those bills. HUD makes the lender pay those back taxes because they can't have a running lien. And then they had to work a payment plan out with the borrower. It's a lot of issues back then, so they fixed that. They also restricted how much people can borrow within the first year. So if you have a reverse mortgage, and let's say it's about 300 grand, you used to be able to take 300 grand at closing, even if you had nowhere for it to go. You just wanted it. Just sat in your checking account. And if it's sitting in your checking account, what's it doing? It's accruing interest, right? Because you borrowed it. So HUD wasn't comfortable with the lump sum drawing of the full loan day one. And they said, we're going to restrict in the first year. Take about 60% of your loan in the first year. After that, you can take the whole loan. So it's just a way to sort of train them to be responsible with it. This is not a loan to just take out and buy cryptocurrency and buy boats and go to Foxwoods. It's not against the law to do that, but it's really to just provide some stability financially to maybe live there the rest of your life if you use it responsibly. I'm not going to get too much into this. This is about purchase. You know, if you're selling your house, I'll get into it real quick. So I meet with you. This is your house. You're 70 years old. No mortgages on it. And I look around here. Maybe you're on a walker, and I say, by all means, Tom, I can do a reverse mortgage and help you on this house. But it seems like an awful lot for you to handle with the yard maintenance. And you say, yeah, I agree. And I would say something like, have you considered selling? And you say, well, yeah, but that's a task and a half. Plus, where do I go? I'm only going to walk away with $700,000 when I sell it. So the next slide is it's gonna make pretend you said, yeah, Dave, let's sell it and move on to the next place. So the next slides. So going back here, the scenario is this: we're going to sell this home for $700,000. You have no mortgages on it. We're going to find something for $600,000, maybe a ranch that's smaller, maybe a quarter-acre lot, easy to manage, it's all updated, okay? And you don't want to have a monthly mortgage payment. So there's only two ways to do that, and that's what the next slide is going to do. This is saying that you sold this house and you paid cash for the $600,000 house you're gonna buy, okay? So we've sold that house. Now, when you sell that house, you pay 5% commission to a realtor. It costs $35,000 to sell a house. You can get it down, yeah. But on average, it's about 5, that's the old average. So we'll take $700,000, which is sale price, deduct the realtor's commission, net proceeds $665. Now you want, this is just an example of paying cash for the next house, the ranch. So you took $600,000 out of this and you bought it cash and left with $65 in the bank. No mortgage payment. Now the next slide, same thing. You have $665,000 from the house you sold, the net proceeds. Buying a house for $600,000. Now, you can take a reverse mortgage out on that house for about half. So you took a reverse mortgage out for $300,000 of the new sale price.
Right.
You have to come to closing with the rest, the other $300,000. Where's that coming from? Up here, right?
Sure.
Okay? So look at what the financial difference is here. You have $365,000 in the bank because you only needed $300,000 from there. Over here, to buy it cash, you only need $65,000. No mortgage payment here, and no mortgage payment here. But you have $365,000 from the house you sold.
Right.
And you have a home that's easier to live in, costs you less to run, and it has no mortgage payment. It has a mortgage, but no mortgage payment. Now look at the difference. That's the value of the heck of a purchase product. So if you're looking to sell and net out some money to live on, get into the next house and have it cost you less to run,
Right.
and have no mortgage payment, that's something to consider.
But today, with the real estate market crazy as it has become, it's hard to leave a house, like your example here. He wants to scale down the size of the house. I hear stories that it's damn near impossible to do because the price of real estate has gone through the roof. And when he looks around and finds that, gee, I want to go down, you can't find anything suitable because the prices have been so high
Yeah.
that it's like a wash. They might as well just stay here, right?
Well, it's not a wash there, because remember,
Well, not quite a wash, but
you got
it's still hard to
$365,000.
find the lower,
Right.
lower priced home
That's right.
where he thinks I'm gonna be more comfortable in a smaller house.
Yeah,
Today, I hear stories, it's damn near impossible to do.
it is. And that's, again, there's variables in different markets. Right now, you're right. It's a harder market to do
Right
that.
now, right now.
But 10 years from now, it could change.
Oh,
You know, so-
without doubt.
So it's just an example to kind of consider. If you're looking to sell, hey, I can net out some money, put it in the bank, if everything worked out perfectly,
Right.
and not have a mortgage payment. Just another tool to use. But you're right, there's so many moving parts in each different market.
So let me ask you this now. If you have a line of credit,
Yeah,
and let's say you have used it, say $100,000, just for the hell of an example. $100,000 line of credit. It's a floating rate, as these guys are too. What are you recommending with regard to the $100,000 that's already outstanding from a previous line of credit granted by the bank? And then you're talking about reverse mortgages. Would you take the $75,000 which you owe and dump it into a reverse mortgage? Because the rates are probably going to be very similar,
yeah.
right?
So whatever-
Why would you want to do that? I'm just asking a
Yeah,
question.
yeah, no, good question. So your question is, let's say hypothetically, you have a house worth $600,000, you have a $75,000 Citizens Bank home equity line on it. We sit down and talk and say, Dave, what's the benefit if we take this $75,000 home equity line of credit, push it into there? Well, the benefit's gonna be is you're gonna have access to more equity because the line of credit on a reverse mortgage is not based on your income. The $75,000 home equity line from Citizens was, that's why it was so low. Because it's based on your monthly income that you have, Social Security and pension, because you're gonna make a payment.
Well, the initial deal anyway.
Yeah.
Because it's still a floating rate.
Right, both have floating rates. On the reverse equity line of credit, if you have a $600,000 house, you're gonna be able to, your ceiling loan's gonna be about $300,000.
Right.
So if we're only paying 75 out of the 300, not only did we pay that off with the reverse mortgage, you no longer have a payment anymore, whatever you were paying to Citizens every month, but you also have the additional money in a new line of credit that's unborrowed. But it's there in case something comes up. So the benefit was you relieved yourself of the payment, and those loans don't last forever. Home equity lines have a 10-year life. So once you get to year 10, they take that balance you have, turn it into a 20-year regular mortgage with the prevailing rates, and in most cases, the payment can triple. With a reverse mortgage, it never expires. It expires when you don't live in the house anymore. So the line of
But
credit
you're
is,
still paying the fixed rate, the variable rate,
you're paying you're accruing a variable rate
accruing it.
on
Accruing.
the
So it
reverse
goes into the
mortgage.
balance, and the balance keeps going down.
That's right. Again, it's a cash flow play.
Right.
So, and not only that, it's gaining access to more equity versus you just having a $75,000 balance and you're paying a payment on it. You don't have access to more equity. Putting it into the reverse pays off the 75, and you still have money left over in a new reverse equity line of credit to tap into if something goes sideways.
So it's a matter of the rates. What am I paying on the 100K that I have outstanding, rate-wise, and it's a floater, versus the reverse mortgage rate?
About the same.
It probably is, right?
Yeah, well,
They're probably in sync.
They're probably close. Right now, these variable rates are about 7.3%, right? And so they can adjust monthly. Prime rate adjusts monthly too.
Right.
And what the banks do is they take a fixed margin of 3%, add it to the Fed funds rate.
Right.
So when the Fed raises their rate, they have this rate is probably, I don't know, by this time it's probably 3%, 3.5%, 4%. So say 4 plus the 3,
Yep,
their margin is 7.
yep.
And then as the Feds raise their rates again, the prime rate will be directly affected by that. But they all kind of follow the same, maybe not the same day, but over time, they sort of all average out together. You're never going to have a variable rate of 2 still and a prime rate of 7. They're all going to be right in line with each other.
So if the line of credit has an extension, an expiration date of whatever,
10 years, not the
10 years?
reverse line of credit, the home equity line.
home
Traditional.
equity, home equity, 10 years, let's say,
Yeah,
and you're now in the 9th year, it becomes almost a no-brainer. Because,
to switch it into reverse, yeah,
yeah,
because.
unless you have life insurance to cover the balance on
That's right.
the line of credit which you borrowed against, and you die, and your heirs get the life insurance proceeds, let's say, that's the way
Yeah.
it's set up in the will,
Yeah,
then you're okay,
yeah, exactly.
basically,
Yeah.
I think.
So, and it's a good point, because what happened, the phone calls I'll get are something like this. Hi, you're calling me, hey Dave, this is Tom from Foxborough. I've had this home equity line with Citizens for, now it's 9 years. And I know it's expiring next year, and at the time we took it out, my wife was alive. She passed away during this past 9 years, so when we took it out, we both had income. If I gotta go back to the bank in 11 months from now and try and have them recast this to a new home equity line,
Right.
they're gonna say, ooh, your income's been cut in half, you don't qualify to redo that. And you say, what are my options? They're gonna say, you don't have any options, we're just gonna recast this balance of your home equity line into a 20-year term loan at a fixed rate. And so that's, and I've gotten those phone calls, people will call and say, my payment was $130, in 2 months it's gonna be $690. And I can't refinance it because I don't have enough income, I lost my husband or my wife. And so they're calling me.
Generally, that person would have access to her 401K balance. It's not
If they
its
do,
own.
right, if they
I
have
mean,
access to
it's
money or life
automatic.
insurance money, but not everybody, believe it or not. Some of the folks that have called me, there wasn't life insurance money that they got. There was no money when the spouse passed away. All they did was lose their income they were getting every month. But, yeah, you're right, some people might have IRAs still. They can just take it out of that,
Right.
pay it off, and be fine with it.
And they're first in line for the spouse.
Yeah, exactly. These are just some of the common misconceptions. A lot of times people think for some reason when you do a reverse, you no longer own the house. That's never been the case. That's an enduring myth. When you do a reverse mortgage, you're refinancing your house, right? So the title of the home stays in your name. At the closing, you sign some paperwork, it's still in your name. So it's not owned down the road by a bank. It's not owned when you close by the bank. It's owned by you. But that's just a common misconception. And a lot of people think they can't do a reverse mortgage until their home is mortgage-free, and we've already talked about that. Now, the equation is if you have a house worth $600,000 and you have a $400,000 mortgage, you're not going to qualify, because $400,000 is more than what you can qualify for the reverse. Remember, it's about 50% or less.
Right.
So if you had $100,000 home equity line of credit with a $600,000 house, you could qualify and pay that off and still have some left over. But the bottom line is it doesn't have to be mortgage-free. You just have to have sufficient equity to put a reverse against it and pay off those regular mortgages.
Right.
And then this is the most common here. So that fee that's paid, that insurance fee we talked about earlier, the one-time fee, what that does is that eliminates all liability for anybody, the borrowers, me, the lender, and the estate. No one's liable for that mortgage debt, period. So there's no danger if that mortgage debt surpasses the value of the home at some point in the future. It just means there's nothing in the house for the kids to get. But there's no danger in being harassed by the bank.
But you paid your dues to get that.
You paid your dues to get that.
Program.
Exactly. Right. The house, the equity in the house paid that.
Right.
So the kids are never on the hook. So it's zero liability.
Right.
If there's any money left, it goes to the kids, though. There's no sharing of that.
Right.
The loan costs. So there's three costs. This is the one we've talked about so far. You take and let's use a house worth $600,000, because the higher the home value, the higher the cost, right? Because it's 2% of the appraised value. You get $1 million house, that's $20,000 in insurance money. You get a $300,000 house, it's only $6,000. So the costs go up with the value of the home.
Right.
But let's use a $600,000 house.
Right.
We know that's $12,000 going to HUD and FHA one time. Comes out of the equity. No one's coming to closing with a checkbook for these costs. Comes out of the home. This is an origination fee. All loans have that. You go down to Foxborough Credit Union, take a mortgage out, they have an origination fee. This is standardized and capped by HUD. On average, for a $600,000 house, it's about $6 grand. So now you've got 12 grand for the insurance fee,
Right.
6 grand here, we're at 18. Then you have an attorney that does the closing, right? They do all the title work, they do all the paperwork in 60 days, they record it at the registry of deeds.
Right.
It's about another $2,500 to $3,500, depending on the value. So you're over $21,000 coming out of the house's hide, right? Just like when you sell it. Comes out of the house's hide, gets paid to the real estate broker. So it's rolled in, so it's expensive. But it can't be compared to any other mortgage because all other mortgages have a payment. They're not backed and insured by HUD.
Right.
It's a recourse loan. Mine's a recourse loan. If I don't make the payment, the recourse is take the house. So it's just, this is what makes it expensive. But there's reasons why it's expensive. It's just not an expensive loan. They're a ripoff. But it doesn't make it the
Well,
right
people
loan.
abuse the privilege of having this set up to begin with.
Yeah.
And they're mismanaging their financial assets and get in trouble. And then enough of these things populate, like, oh God, here we go, non-earning asset again, and bang, bang.
Yeah.
Right? So it ruins it for everybody else. Basically.
So, I mean, sort of. It's really, the way you have to think about it is you have a home, it's your house, right? You have equity in it because you made a bunch of payments for your lifetime, and the home value went up, you made payments, and you have this stretch of equity.
Right.
It's an asset to tap into. It's not a humiliation thing to tap into, it's an asset. You might have IRAs, Roth IRAs, stock accounts, bond accounts, and you have a house account. It's just no one looks at the house as well.
Right.
They say, God forbid we want a mortgage on that. And I agree, it's okay not to have mortgages on a house. But if 2/3 of people over age 62, 2/3 of their wealth is in their house. 1/3 is in savings.
Right.
But they never consider the 2/3 in their house. This is just a way to consider it. It's a tool,
Right.
among many other tools. It's not the only tool, it's a tool. And it's worth learning about, so I commend you for learning about it. That's all we're doing today. We're not selling you on this.
But
It's not a product to be sold. It's to learn about it. What's the downsides? What's the pros? What's the cons?
Right.
And that's all you're doing, so I commend you for that. The only out-of-pocket costs are right here. So if you decide to move forward, we put your appraisal fee on a credit card, one of your credit cards. And then there's a mandatory counseling fee. That's a safeguard that's in place by HUD. I do this for a living. So if we sit down and you say, Dave, it sounds great, let's move forward, we can't. Because HUD wants you to sit down or talk on the phone for an hour with a pre-approved HUD
that's a
counselor.
requirement.
Yeah, it's a requirement, it's mandatory.
You have no choice.
You have no choice. And it's good though. You should hear about this from someone who's unbiased, who's neutral, who doesn't do reverse mortgages for a living. Because you want to make sure the stories match up. You want to make sure the guy or gal in your house is telling you the whole story. You want to make sure they're talking to you about, hey, did you know these loan balances go up? Hey, did you know these are expensive? Let's talk about why they're expensive. They're not just trying to sell you on it. So that counseling session might uncover some unscrupulous things. That's all. It's a safeguard. So those are two out-of-pocket fees. Counseling ranges between
And the appraisal fee is a standard real estate appraiser
Yeah.
that comes out and does this thing.
It's an FHA certified appraisal.
Right.
So there's just some different standards that FHA has for the property. The process of taking out a reverse mortgage, if you're ever interested, you should only be looking at someone who has this designation next to their name, Certified Reverse Mortgage Professional. We are the gold standard nationwide.
So that is a designation for people like you?
Me.
You have to pass an exam?
You have to pass an
It's like
exam.
a certified financial planner?
Sort of,
You have to take a test?
yes. Take a
And pass
test in Boston, yep. The challenge with, and there's less than 200 CRMPs in the entire country. 200 or less.
Why so low?
It's a hard designation to get.
So what?
It's a hard designation to get. It's not easy to get. They don't want it to be easy because if I told you I was
Certified financial planner, I'm sure it's not going to be any easier or harder.
well, there's thousands of financial advisors and financial planners.
True.
There's not a lot of reverse mortgage professionals. There are people that do regular mortgages and they dabble with reverse mortgages.
Right.
There are very few that just do reverse mortgages. And so for those of us that just do them, we take it seriously. We're passionate about helping seniors. We're passionate about educating, not selling. And so to be a CRMP, you have to be in the business a minimum of 3 years. And you had to have closed 25 reverse mortgage transactions first before you can be considered. Once you've done that, now you have to submit some paperwork to the National Reverse Mortgage Lenders Association. They check out your reputation. They do a background check. And then they have a meeting and say, we feel like the reputation's there, so this person can now pay us some money. They can study for their test. Then they go to Boston and take the test. A lot of people have gotten to that point, but there's about a 33% failure rate when they take the test.
That's what I'm about to ask you.
Yeah. And it's the test that knocks them out. And then you have to wait 6 months before you can retake it. Sometimes people just say, the hell with it. But just look for someone who's certified, locally. You don't want to do a reverse mortgage long distance, meaning you see Tom Selleck or Henry Winkler's commercial, because you're calling into an Oklahoma call center, and you're not going to get the attention. My clients get direct attention. I'm there for them as long as they have the reverse mortgage, and I'm there for their kids.
How many clients do you have?
Over 500 clients that have done reverse mortgages in 17 years across Massachusetts.
So they have come through you
They've come through me directly.
to do this?
Yep, except over the past
500
17 years.
people.
Yep.
You still talk to most of them? Half of them? Quarter of them?
Some have
Once
died.
a year?
Yeah,
I imagine you got a few deaths.
I have clients that call me and send me Christmas cards. Yeah, we are in touch a lot. They call me when
They're
they get
afraid of
sick.
dying, that's why they send you, they keep in touch with
Yeah,
you. It gives them
yeah.
a sense of wanting to live.
I treat all my clients like my family. That's just the way I am. I was raised to treat anyone I come in contact with as if they were my mother and father, period. I know no other way to do it. So if I don't think a reverse mortgage is good for someone, I'm going to tell them that. It's just the right thing to do.
Right.
So that's why I've been able to just do one thing for 17 years and be really good at it. It's not because, it's just my reputation. Most of my business comes to me, hi, my elder law attorney told me to give you a call. My financial planner told me to give you a call. I do a lot of radio stuff. I do radio advertising. I do a lot of these workshops. So I do a lot of social media. So it's about reputation, especially with this product.
Right.
So get educated by a certified reverse mortgage professional.
Right.
Then if you decide to move forward, you have to do the counseling. We provide the list of agencies you pick one.
Is that negotiable?
What, the counseling?
Yeah.
No.
The fee?
No,
The fee?
no,
No?
no, it's between 150 125 and 175. I mean, anything's negotiable in life. You can ask the council, but we can't negotiate it. You say, hey, can you go do better on that fee? Probably gonna say no. It's a large corporate agency, but you can ask. Then an appraisal's done after the council. Well, you sign a loan application after this step. Then we order an appraisal. Appraiser comes out, does an inspection. Then it goes into the lender. The loan gets underwritten, and then it closes. From here to closing, on average right now, about 30 to 45 days. And that's it. That's all I have.
Very good.
Any questions?
Very
Any
informative.
questions, ma'am? Nope. You can call me anytime.
Yeah,
My commitment to the Council on Aging, I do about 20 to 30 of these a year at other COAs in the state. My commitment is just to be a resource. So if
How many
you have
of you
questions,
are there active in the state with this designation in the state?
like 5 to 7,
5 or 7?
yeah.
Yeah.
I know them all. It's a small industry, so we're friendly. There's so much business to go
You
around.
don't refer business to one another, do you?
Sometimes,
Yeah.
yeah,
So you
sometimes I
don't want
will.
to go to the Berkshires?
If I'm too busy, yeah, and I know a CRMP that's out near the Berkshires,
Right.
I'll say, hey, George, can you give them a call? You know, and vice versa.
Right.
So I don't badmouth any of these people that are certified because we're all friends. It's a small industry and we all kind
Well,
of.
you can't afford to do that.
It doesn't get you anywhere. So I've been up against some of them. I'll go there and I'll see the quote and they'll say, why should I go with you and not them? I say, well, we're both good at what we do. You get a pick. And then they pick. We don't badmouth each other. So,
Okay.
Any-
Right?
Thank you.
thank you.
Appreciate your comment.